I'm here with Justin Lannen, and we're here to talk about global listed infrastructure. Justin, listed infrastructure lagged global equities in the third quarter. What were the main drivers behind this?
Hi Simon. Yes, it has been quite remarkable that listed infrastructure did lag behind global equities in the September quarter and also year to date. Considering that the underlying financial performance of the listed infrastructure companies has held up really well this year. There have of course been a few listed infrastructure sectors that have had real and direct impacts from the COVID crisis, such as the toll roads and the airports. What we saw in the September quarter was that the fund on an unhedged basis was down 3.4%, and this compares to the FTSE 50/50 index, which was down 2%. Now, global equities were up over the September quarter by 3.7%, and this really is a continuation of the story in 2020. In 2020, there's been great economic uncertainty and also interest rates have fallen significantly. So that's an unusual period for global listed infrastructure to lag behind global equities. However, we think some of that is explainable and also some of that is not explainable. And that's where it gets interesting for global listed infrastructure investors.
There's been a large dispersion of performance within the GLI sectors. Did we see a change in the third quarter?
The toll roads, airports and pipelines have all been particularly hard hit by COVID in 2020. We think that the stock market has been mostly correct in marking these asset prices down given the financial impact. In the September quarter also, the transport infrastructure sectors in particular were hard hit due to second wave effects, particularly in the Northern Hemisphere and also in Melbourne. The three hardest hit sectors that I mentioned make up around 25% of our fund. However, we have 57% of our fund in regulated utilities, and these companies in particular have held up really well in terms of profit and financial balance sheets.
Toll roads has been severely impacted by COVID. What is the outlook for the sector?
Well, short term, the toll roads have been hit hard by the crisis, and we did see second wave fears in the September quarter. However, we have seen on certain roads around the world that traffic already is starting to bounce back, particularly as people have a preference for driving over travelling on public transit. Although the work from home theme is a serious threat to some toll roads long term, we think, particularly the inner city roads, where people have the option of working from home, much more so than regional roads where there are less work from home jobs.
The US presidential election is coming up. What impact does that have on the GLI space?
It won't have a huge impact on the fund, despite 48% of the assets being in US listed infrastructure. In the US, state-level decisions are far more important than federal decisions. That said, a Biden victory would be a modest positive for the regulated utilities because it would enhance the rollout of renewable power in the US.
Most economists are forecasting interest rates to remain low, at least over the medium term. What's the outlook for GLI in this environment?
Generally, infrastructure asset valuations are increased by lower real interest rates. And as I mentioned before, 57% of the fund is invested in regulated utilities. We think that the North American regulated utilities are a standout currently. These companies are very sensitive to lower interest rates, and they really haven't seen a material financial impact from COVID. So Simon, this is an unusual year in infrastructure markets, but we are finding opportunities to remain optimistic.